at the same time, you mentioned somewhere about life insurance combining them both. But at the same time, what if someone doesn't have insurance for life and mortgage both and they pass away? From what I understand, it goes to their estate or
Mhm.
someone who is on the wheel, but they still have to cover that money or not? I'm not sure. Sorry, I have just a gray area in that.
Okay, so let's separate the different concepts and then we'll bring them together. Okay, so I'm going to clarify it's funny for everybody, not just for yourself. So I may be saying stuff that you understand, but just so that for everybody's benefit.
Mhm.
Okay, so mortgage insurance. There are different types of mortgage insurances. So the first one is known as default insurance, mortgage default insurance. So mortgage default insurance will be required when somebody gets a high ratio mortgage. So high ratio mortgage is when somebody is putting less than 20% down, right? So their loan to value, the amount of money they're borrowing on the property is less than 80% of the value of the property. So that's a high ratio mortgage. Conventional mortgage, on the other hand, would be when you're putting down a 20% down payment, or the person is borrowing less than 80% loan to value, which means their mortgage is less than 80% of the value of the property. So in the conventional mortgage, the person does not need default insurance. So the reason we have default insurance is because otherwise, so when the person is putting down, let's say 5%. So let's say it's a first-time home buyer, they only have 5% down payment, right? So many banks will not lend to this person because the property prices may drop by 5%, and then there will be no equity in the property. That means the person doesn't have any skin in the game. They can just walk away. So should the market drop, let's say by 10%, the person can just say to the bank, here, take your property back, I'm gone. Right. So the banks then have no confidence in the person's ability to pay the mortgage. So what the government did was they came up with this default insurance. So CMHC provides default insurance, which is a government agency. Plus, there's a couple other insurance companies. But anyway, so what CMHC does is they'll say, okay, we will guarantee the loan. So that's the insurance, right? Default insurance. So they're saying, we will guarantee the loan. So please lend the money to this person. If for whatever reason they are not able to, they default on their mortgage, so they're not making mortgage payments, you can take the property back. And if you suffer a loss, we will cover that loss, right? So let's say in this case, the bank took the property back, and then they sold the property and they're out $10,000. The rest of it is paid off. Then CMAC will pay them $10,000. So that's how the default insurance works. So default insurance is required when somebody has a high ratio mortgage, which means they're putting less than 20% down on the property. Okay, so that's default insurance. Now, there's also what's known as mortgage insurance.
Oh,
Mortgage life insurance or mortgage insurance is so this will protect, so default insurance protects the banks, but mortgage life insurance will protect the person. So let's say I get a mortgage, and let's say something happens to me and I pass away, I don't want my family to then have to worry about selling the house, right? I don't want my kids to then have to go find another house, or my husband to go find another house to live in, and so forth. So in this case, what I could do is I could get mortgage insurance. And this is a question that the banks will ask you, the lender. Every lender is required to ask if you want mortgage insurance. Now, mortgage insurance, the only thing with the mortgage insurance is it's so over time, the mortgage amount will decrease, right? So let's say somebody started off with a $400,000 mortgage. After a year, it would be less than 400,000. After 2 years, it would have decreased even more, right? Because they have been making payments, and some of those payments are applied towards the principals, which mean the mortgage amount is going down. But the premium doesn't go down, right? Even though the person, let's say they were to pass away 5 years later, the 400, they're not getting $400,000, right? So basically, in the event of the person's death, the insurance will pay off the mortgage on the property. So the problem with this type of insurance is that, well, it's a good thing that it protects the person, right? In case they, so let's say I were to pass away, I have mortgage insurance, whatever's owing on my property will get paid out. So my family doesn't have any, they don't have to worry about mortgage payments. So that's this good part. The bad part is that even though after, let's say, 5 years, there's only 350,000 owing on the mortgage, I'm still making payments for 400,000, right? So that's not fair. Even though I made premium payments for 400,000, I'm only getting 350. So it's a declining amount. So the mortgage premium doesn't decline, but the benefit declines, right? How much they're paying declines. So that's not the good thing. That's the downside of mortgage life insurance. And then there's also, so what you can do is there's another option. So one option is you buy that mortgage insurance from the bank. Second option is you can just go to an insurance company and say, hey, I want life insurance in the amount of my mortgage, right? So you will say, okay, I have a $400,000 mortgage. I need a term insurance, excuse me, for 500,000. In this case, or did I mess that up? So let's say 500,000 mortgage, you'll go get a term insurance for 500,000. So in this case, your premiums will stay the same, but the benefit amount stays the same as well. So let's say I get that mortgage, something happens to me, I pass away. Now my family will not get their mortgage paid off, but the insurance company will give them 500,000, which they can then use to pay off the mortgage, right? So that's known as life insurance. So those are the different types of insurance products that you will come across as you're practicing. So in terms of getting, it's optional. Mortgage life insurance is optional. You don't have to get it. But if a person wanted to get it, they can either get it through the bank, which is mortgage life insurance, or they can get it through a separate insurance company, which is independent of the bank. And in that case, it would be a term insurance, and it will stay to whatever the benefit amount is. The premiums will stay, will be dependent on the amount they're asking
So
for.